Go ahead and start since we are the last one of the day and everybody would like to probably be done. My name is Joe Toms and I'm a managing director of Lending Club. I am actually a new addition to the team, and I think probably a good way to start is sort of tell you how I came about to the team. My background was I've been in the asset management business since the early 1980s. I was one of the original shareholders and director of research of a firm called Fisher Investments that today runs about $35 billion. I ran a $500 million long-short equity hedge fund in the 90s. I also was CIO of a firm called Compass Global Investors. It was a $2 billion size fund of funds. And I've been a director of RAB Capital, which is a large London-based hedge fund. And one night I was having dinner and my friend, who was an individual investor, was complaining about how tough the markets were. And I said, well, has anything worked for you? And he said, yeah, one thing has, and it's called Lending Club. And I said, well, that's sort of interesting. What's that about? And so he told me the story, of which I'm going to relay to you more today. And I promptly went to the SEC's webpage and looked at the 10K and 10Q. I'm an equity analyst by training, even though I've spent time on a lot of other markets, and was amazed at the fact that I think the company truly addresses one of the final structurally inefficient markets left in the world with size. And to me, that was a very exciting and compelling notion. And net, I spent time with the CEO, and here I am today helping run the investment side on Lending Club. What I thought I'd do is tell you a little bit about the company, tell you a little bit about the opportunity, and then obviously answer any questions I can as we go forward. First off, who we are. We're often referred to as a peer-to-peer lender. I hate the name. It makes it sound like it's a cottage industry. One of the things I'm going to talk a little bit more about is this is not a cottage industry. This is a huge market. We were founded in 2006. We issued our first consumer note in July of 2007. To date, we've issued over 160 million of consumer notes. We have 42 employees, a very experienced management team. Renaud Laponche, the founder, founded a previous company called Matchpoint that he sold to Oracle 4 years ago. We have a strong team in credit analysis, in marketing, and in technology. And we're headquartered in Redwood City, California. We have a veteran advisory board. We have the ex-CEO of MasterCard, the ex-chief risk officer of MasterCard, the ex-VP of the North American Consumer Risk Group out of Citigroup helping us. We continue to strengthen top management. We just recently announced the hiring of our chief financial officer, Carrie Dolan, who was previously the CFO of Schwab Bank. Scott Sanborn joined us as the chief marketing officer. He was previously the CMO of eHealth and the senior vice president of marketing for Home Shopping Network. And as I mentioned, I just joined to help run the investment side. Where are we? We have a fully developed online loan acquisition and processing platform that we've put together over the last 3 years. We can originate and service prime consumer loans, we think, more cost effectively than banks. We have a proven 3-year track record now of success. The investors have earned, on average on our platform, 9.42%. And at the same time, borrowers have saved over 200 basis points in annual interest costs. 2/3 of our growth has occurred in the last 10 months. Over the last year, our loan origination or generation is up over 500%. We really feel now we're in a place where the platform's in place, we've got the proven ability to do this, and now we can grow. Financing overview, we've raised $55 million in 3 previous venture rounds. We just did a Series C round for $25 million in April 2010. Venture backers are Norwest, Cayman Partners, Morgenthaler, and Foundation Capital. And we currently have $25 million in cash on the balance sheet. Revenue and profitability review. We looked this year to do $7.5 million in revenue. We're shooting for $24 million at the end of next year, followed by $60 million the following year. Profitability milestones, we're currently positive gross margin, 60%. Contribution margin positive, we expect at the end of this quarter or fourth quarter 2010. We expect to be cash flow positive in the fourth quarter of next year. I want to spend a few minutes on the overview of the opportunities I've mentioned. I think it's important to redefine the label of peer-to-peer lending because it is truly a huge market. It has tremendous structural inefficiencies. There are also risk misperceptions about the marketplace. There's strong secular trends that we think will support this opportunity in the next 2 decades. Talk a little bit about our competitive advantages, and then talk about why it's a scalable model. this gives you a little perspective on the size of the market. As of 2009, outstanding consumer credit was $2.45 trillion. There's primarily two categories, which is non-revolving, about $1.5 trillion, and revolving about $850 billion today, if you look at the numbers. If you were to take that whole market, it would be the equivalent to the sixth largest GDP in the world today. Only the United States, Japan, China, Germany, and France would be larger. In terms of equity markets, it would be equivalent to the fourth largest equity market. Now, we're focused right now on that $850 billion unsecured. We'll talk a little bit why behind it, but the point being, it's a very, very big marketplace. It has an amazing structural inefficiency. What these bars represent are the drop in interest rates from their peak in October '81. In the case of the blue bar, through June '07, pre-crisis, because some people think it was maybe different before the crisis. And then the second bar as of through June 2010. And what they show, no big surprise to this, is that there's been a huge plunge in interest rates. But the only place there hasn't been a huge plunge in interest rates is in consumer credit. And the obvious question you ask is why? And the answer we would tell you is because to really effectively make money in consumer credit, you have to be able to have a broadly diversified portfolio across enough loans that you actually have some predictability on both your delinquency and charge-offs. If you do not get size in terms of the numbers of loans, you do not have a certain outcome. And then when you ask who can actually do that, the only people that can actually do that are financial companies until now. What we think we can do and have done is construct these broadly diversified portfolios that we do get the actuarial assumption we want, and we can capture the difference and bring it to our borrowers and investors in place of that. But this structural inefficiency, we would argue, will disappear, but it's something we can take advantage of. The other way you can see the structural inefficiency is to take a look at it from the standpoint of the banks. And what this bar graph represents is if you take a look at total credit market debt broken down by individual categories, treasury securities, agency, GSE paper, et cetera, and you ask how much do banks keep on their balance sheet, the answer is the second highest category is consumer loans. And I think a fundamental rule of risk is if you think it's really risky and you don't get paid, you don't keep it on your balance sheet. And so the question is, while people think consumer loans are risky, I want to come back to that in a minute about the risk perceptions of consumer loans. The fact is, banks keep this on their balance sheet. Now, new rules will even make them do that more so, but this is based on 2009 data before the regulatory stuff was passed. And to us, that's another indication of the structural inefficiency of very high interest rates, very high profitability. Some of the risk perceptions. This is the average interest rate from March 1972 to June 2010, again, of various different fixed income instruments. And what you'll see is that the average interest rate on credit card unsecured debt has been very high. And the reason people will say is because it's very risky. Yet the history of charge-offs, which is that little sort of red bar there, has been 4.5% average, which still leaves a potential excess return of 400 basis points. Now, it actually, in our opinion, is better than that, because if you look at the way consumer credit card companies price, they don't use risk-based pricing. What they basically do is take good consumer credit risk, still charge them a very high interest rate, use that to subsidize both offers and things of the other sort to other customers, and try to collect lower quality customers, but again, by using the financing from the good, can come out to a return that makes a lot of sense. We look at that and think our opportunity is to aim ourselves at what we think is the high quality consumer credit risk in that pool. When you look at the actual data, which is actually hard to get your hands on to, but if you look at the FICO score data and other things of the sort, what you find is that the high end, the top 10 to 20% of consumer unsecured credit has an incredibly low default rate. And that, contrary to the average at 4.6, which has been as high as 10.11 or 10.10 or 11% during the crisis, as low as 2% prior to that, consistently the best credit tranches in unsecured consumer credit, i.e. the best credit risks, have had very low default rates. So we think by isolating the best credits, we think it's possible to minimize our defaults, decrease the borrower's interest costs, making it a compelling value for them, and increase investors' yields, making it a compelling value for them. Couple points on long-term secular trends. I'm sure you've all seen this before. This represents total credit market debt to GDP. We're convinced that we are in the beginning stages of a deleveraging cycle. We don't think that's going to be over in the course of the next year or 2 years. We think it's actually secular in nature. I think you'll see over the course of the next decade a lot of financial articles talking about how you reduce your debt, all these kinds of things. So we feel in the long term, from a borrower's perspective who are looking to deleverage, that we offer a solution to them that's better than they can get in other places. The other big secular trend that's going on right now is the age wave, which I'm sure you're all familiar with. This represents a 60-year-old age group, 10-year rolling change as a percent of the total population, and I'm sure you've seen the data. We are about to experience the largest growth in the older population in the history of the United States. No big surprise. Most people don't like risk in that group. They don't want to take equity risk or commodity price risk. What they want is yield and current income. There are no opportunities in yield and current income right now for the most part. And we think that this also plays to the trend of investors looking for current income and yield to help support their portfolio. We think we can do this because we've built a competitive advantage, which is fundamentally a lower cost structure. I'm not going to get into all these pieces, but suffice to say that the combination of the things that we list, from customer acquisition down to distribution, we think we can do cheaper. And why? Because we're purely an internet-based play. We don't have branch offices, we don't have deposit taking, we have a different regulatory framework, we have a different infrastructure framework, and we have a different ability to reach out to customers, which we think drives our costs significantly below what it would be for a typical traditional financial company. A little bit about the process. The process is driven pretty straight ahead. We use our internet channels, which include things like associations with websites like LendingTree and Mint, to drive traffic our way. We do a quantitative and manual credit analysis where we isolate the borrowers into what we think are the top 10%, and I'll come back and talk a little bit more about this in a second. We assign loan grades inside that in interest rate assignments based on what we perceive as the risk of those loans. Higher obviously pay higher interest rates. And then we originate consumer notes in what are 36 and 60-month fully amortized notes that we then put into broadly diversified portfolios, which are constructed by the client based on their risk tolerances. A couple key points here: we do not take credit risk. That's the client who takes that decision. So we're not using our balance sheet in terms of that. And two, we want to give the flexibility to the client to decide based on their own risk tolerances and income needs where they want to be in regards to the risk profile of the loans. As I mentioned, we really try to screen the top 10%, but we look at the top 20% of consumer borrowers. Today, our average FICO is 724. I don't know how many of you are familiar with the FICO scores, but it's a very high FICO score above typical credit card companies. 10% debt to income. We look at over 180 different credit variables, some of which are listed there. Where necessary, we will do manual verification, which applies to about 40 to 50% of what we do today, where we actually take a look at employment history and income history, verify that. To date, we've done, as I mentioned, about 160 million in loans. Yeah.
Does that include mortgages when it says 100% debt take?
Yes, it does. Well, no, it includes mortgages. No, I'm sorry. You said, does it include mortgages? No. And then we've declined 1.5 billion. But that's actually a really good point. Let me address that for a second. If you think about the classic person who we're looking at, they don't have a mortgage. If you think about the way this works, and you were to take a look at the demographics of unsecured consumer credit, the majority of it's going to be sort of the 28-year-old, the 48-year-old who's had a credit history of anywhere from 4, 6, 8, 10 years. Now, we require a certain amount of credit history, obviously. But they're in a place where they haven't built up the equity to buy a house. Nobody's going to go borrow interest rates at 12 or 14% when they have a home equity line that they can do it for. Right? So you've got this sort of demographic of people who are trying to get there. And what we're look at that group, we try to find the top 20% of those that we can then help in terms of lowering their interest costs. Now, obviously this is biased from where I stand, but I think too, interestingly, because of the mortgage crisis, the people who reached and threw themselves up into mortgages are now really sort of got the boat, if you will, capsized. Whereas these people have not had that ability. So we actually think there's less credit risk in this group today than there was 5 years ago, because they haven't stepped themselves up and buying into the mortgage markets that then subsequently went down quite a bit. This is not a very good graphic, but what it's meant to design or to show you is the loan grades that run from A through G. We only do A, B, C, D, and E. How do they get to F and G? They turn into a bad loan. They don't pay, delinquency, charge-off, et cetera. And then you see the associated grades, which run from A1 to A5, same thing for each one, and then the associated interest rate that's related to what they pay. The point of this is that you as an investor coming to the platform can come in and decide where you want to be on that risk spectrum. We're agnostic to that risk spectrum. What we think we're trying to do is provide people the opportunity to invest in yielding paper based on their own risk tolerances, as you see there. A little bit about the return history. The 07 and 010 are annualized because we don't have full years in either one of those. We started in July of 2007. But you can see the platform has been very consistent in generating a return for investors based on the average platform return. So it's been 11%, 10%, 7.52 in 2009, reflective of higher charge-off rates due to the economic crisis. And this year we're going to probably end up at the end of the year at about 11%. Averages since inception has been 9.42%. So it's a very, we think, competitive way to generate current income for portfolios and a competitive return relative to other alternatives. If you think about it in terms of correlation, I don't think you'll find this too surprising, but it's very low correlated to other major indexes, including Barclays Aggregate, which is obviously high quality, precious metals, high yield, but you have a very negative correlation in terms of our product relative to other investment opportunities. So we think that the investors not only get a high yield, but they get a very low correlation or low correlated asset to own in their portfolio. This is almost impossible to read because it's just too much numbers on a small piece. But what it is provides you the monthly returns for the total platform and then by loan grade. So you can actually get a sense of the kind of volatility investors can expect, what they're getting. There will not be real big surprises here. Grade A loans have lower returns. And when you get to the higher risk, lower grade loans at the bottom, there's more volatility and not as high returns. But again, that's a key for the investor to decide what they want to do in terms of what they want to invest in. And in summary, because I'm a little ahead of time here, but I think it's pretty straight ahead. What we want to do is create high quality, broadly diversified consumer loan portfolios that offer investors return, correlation, and diversification benefits. At the same time, we want to reduce borrower costs so that we think we benefit both sides of the equation on that. Two, we right now currently possess a fully developed online loan acquisition and processing platform that can originate, analyze, securitize, and service these notes more cost effectively, we think, than banks. We've got a very experienced management team, which we continue to add to. We have strong balance sheet and growth metrics, which I've alluded to before. A huge market. We think it's absolutely, just the beginning, the first inning, as John, who was here with me today too, has mentioned, it's very early in the game. It's structurally inefficient, so we think we can attack something that will provide a benefit not only to us, but to our customers. It has strong long-term secular trends that we think will support us in the next 20 years. And we think it's a very scalable model. And finally, we think it's a very compelling value proposition in today's world for the borrower who looks to lower their interest costs, but also for investors who today look out and see 50 beep treasury rates, 1.5% treasury rates, 3% muni rates, whatever else. So I'll stop with that. I finished with 5 minutes, it looks like left. I'm happy to answer any questions if anybody has any. Yeah.
Can you talk a little bit more about how you guys evaluate the risk? How do you grade some of the different categories?
Yeah, there's actually, I did not show this here, but there's actually a decision tree, if you will, that breaks people down into various different categories. And the categories are driven by how much they ask, for FICO to start, then how much they ask, their DTI, things like how many other credit inquiries they've had, how many other accounts they have. So there's literally a tree that's what we consider to be a pretty predictive tree of what the risk is. And based off of that, they fall into one of those categories. I should emphasize, I don't want to leave the impression that we would argue to anybody in the room or anybody outside of the room that we're going to be the best credit analysis around. What we think we can do, however, is identify the attributes that give you a pretty high probability of getting some expected return out of that. And if we broadly diversify it across a large enough platform, we're pretty confident we'll get that return. If that answers the question. Yeah.
What is your regulatory framework?
Good question. The regulatory framework, we're not a depository institution, so we do not have to fit under banks. We have some lending requirement regulatory issues, which means we really primarily deal with the state regulatory laws. Our notes are registered with the SEC. So our notes, we have a $600 million shelf that we just sort of refile as we go through that process. So from that standpoint, we're the regulatory authority is the SEC, but really we're dealing with the states on a state-by-state basis for the lending rules that apply to the state. Any other questions I can answer? Looks like I'm going to have one in the back, but he hasn't decided yet. No? Okay. Great. Thank you.